Module 7, Unemployment and Inflation. Who counts in unemployment? Discouraged workers, those who have stopped looking for employment due to the lack of suitable positions available. They will not be counted. Out of the labor force, those who are not working and not looking for work, whether they want employment or not, also termed not in the labor force. Underemployed, individuals who are employed in a job that is below their skills. Who's in or out of the labor force? Employed, currently working for pay. Unemployed, out of work and actively looking for a job. Out of the labor force, out of paid workforce, and not actively looking for a job. Labor force, the number of employed plus the unemployed. And here you can see the breakdown. Calculating the unemployment rate. Labor force participation rate. This is the percentage of adults in an economy who are either employed or who are unemployed and looking for a job. Unemployment rate, the percentage of adults who are in the labor force and thus seeking jobs but who do not have jobs. Here's the way to calculate it. Unemployed people divided by the labor force times 100. Based on the data in table 1, what's the unemployment rate in 2016? In this example, the unemployment rate can be calculated as 7.7 million unemployed people divided by 159.1 million people in the labor force, which works out to be 4.8% rate of unemployment. Here's a look at some historical U.S. unemployment, and you can see the pattern. It's fluctuated over time. You can see that in the late 90s and the mid 2000s, it was a low unemployment rate, hasn't ever fallen to zero. The timing of rises and falls in the unemployment rate matches well with upswings and downswings in the overall economy. This says there's been no significant upward or downward trend that's apparent, and now, of course, we're in the pandemic with huge amounts of unemployment. Cyclical unemployment. In a labor market with flexible wages, the equilibrium will occur at a wage, WE, and quantity, QE, where the number of people looking for jobs, shown by S, that's the supply of labor, equals the number of jobs available, shown by D, the demand for labor coming from firms. The equilibrium in the labor market occurs at the wage rate where the quantity of labor demanded equals the quantity of labor supplied. Cyclical unemployment, why wages might be sticky downward. Adverse selection of wage cut agreements. If employers reduce wages for all workers, the best workers will leave. Cyclical unemployment. Unemployment closely tied to the business cycle, like higher unemployment during a recession. Efficiency wage theory. The theory that the productivity of workers, either individually or as a group, will increase if they are paid more. Implicit contract. An unwritten agreement in the labor market that the employer will try to keep wages from falling when the economy is weak, or the business is having trouble, and the employee will not expect huge salary increases when the economy or business is strong. Insider-outsider model. Those already working for the firm are insiders who know the procedures. The others who are outsiders are recent or prospective hires. Relative wage coordination argument. Across-the-board wage cuts are hard for an economy to implement, and workers fight against them. Frictional and structural unemployment. Frictional unemployment, unemployment that occurs as workers move between jobs. Natural rate of unemployment, the unemployment rate that would exist in a growing and healthy economy from the combination of economic, social, and political factors that exist at a given time. It's the sum of frictional plus structural unemployment. Structural unemployment, unemployment that occurs because individuals lack skills valued by employers. The natural rate of unemployment includes only frictional and structural unemployment and not cyclical unemployment. Related to two other important concepts, full employment and potential GDP. Unexpected shifts in productivity can have a powerful effect on the natural rate of unemployment. On the supply side of the labor market, public policies to assist the unemployed can affect how eager people are to find work. On the demand side of the labor market, government rules, social institutions, and the presence of unions can affect the willingness of firms to hire. In recent years, the underlying economic, social, and political factors that determine the natural rate of unemployment can change over time. The Internet has provided a remarkable new tool through which job seekers can find out jobs and at different companies and make contact with relative ease. The growth of the temporary worker industry has probably helped to reduce the natural rate of unemployment, the aging of the baby boomer generation. Inflation, hyperinflation, an extremely high rate of inflation in the hundreds or thousands of percents per year. Inflation, a general and ongoing rise in the level of prices in an economy. And here you can see the price changes from the 1970s to 2014 for certain goods. Calculating inflation with index numbers. There's a base year, arbitrary year, whose value as an index number is defined as 100. Inflation from the base year to other years can easily be seen by comparing the index number in the other year to the index number in the base year, i.e. 100. So if the index number for a year is 105, then there has been 5% inflation between that year and the base year. Index number, a unit-free measure of an economic indicator. Index numbers are based on a value of 100, which makes it easy to measure percent changes. Inflation rate, the percentage change in some price index. Market basket, a hypothetical collection of goods and services, or more precisely, the quantities of each good or service consumers typically buy. Price indices, essentially the weighted average of prices of a certain type of good or service. Price indices are created to calculate the inflation rate, i.e. the percent change in prices over time. Price level, the average of prices. The Consumer Price Index, the average price of goods and services typically purchased by urban consumers. There's 8 major categories: food and beverage, housing, apparel, transportation, medical care, recreation, education and communication, other goods and services. Shortcomings of this core inflation index. It's a version of the CPI excluding volatile economic components like energy and food prices. Improved quality, new goods bias. As the quality of goods improves over time, and as new goods become invented, the prices of those goods naturally increase, reflecting their increased value. The result is that the CPI overstates the cost of living, since some of the price increases it measures represents increases in value, not cost. Substitution bias. As one good or service becomes more expensive relative to others, consumers tend to substitute away from the more expensive item towards the cheaper item. This means that the weights used to calculate the CPI are no longer accurate, causing the CPI to overstate the cost of living. Continuing on, a core inflation index is typically calculated by taking the CPI and excluding those volatile economic variables. The cost of living represents how much it costs for a person to feel that his or her consumption provides an equal level of satisfaction or utility. Substitution bias tends to overstate the rise in a consumer's true cost of living. The CPI tends to understate consumers' standards of living as measured by nominal income divided by CPI. The GDP deflator and other major price indices. Employment cost index, estimate of the average cost of labor compensation to employers, including wages, salaries, and fringe benefits. GDP deflator, price index, which measures the average price of all goods and services included in GDP, used to convert nominal into real GDP. Producer price index based on prices paid for supplies and inputs by producers of goods and services. The GDP deflator and producer price index. Take real GDP, and that will equal nominal GDP divided by GDP deflator. The GDP deflator goes by several names, such as the implicit price deflator for GDP or the GDP price index, but they all mean the price index which is used to convert nominal into real GDP. Producer price index can be broken down into price indices for different industries, commodities, and stages of processing, like finished goods, intermediate goods, crude materials for further processing, and so on. Problems with inflation. 401k, a defined contribution retirement program to which the employee and often the employer contribute. Nominal interest rate, the actual interest rate charged on a loan. Pension, a defined benefit retirement payment. Real interest rate, the interest rate after inflation is taken into account, the nominal interest rate minus the rate of inflation. Confusion over inflation. Inflation can cause 3 types of problems: blurred price signals, unintended redistributions of purchasing power, difficulties in long-term planning. Unintended redistributions of purchasing power. People who are hurt by inflation include those who are holding a lot of cash. When inflation happens, the buying power of cash is diminished. Cash is only an example of a more general problem. Anyone who has financial assets invested in a way that the nominal return does not keep up with inflation will tend to suffer from inflation. Benefits of low inflation. An annual inflation rate of 2, 3, or 4% is a long way from a national crisis. If variability in inflation rates is a problem, then moderate and high inflations are more likely to have significant variability than our low inflations. Low inflation is also better than deflation, which occurs with severe recessions. Moderate inflation may help the economy by making wages and labor markets more flexible. Quick review, I'll let you guys read through this when you take a look at the slides. There's a bunch of questions here that can help you understand what it is you should be taking from this chapter. There is another slide that shows it as well, and then one more. So if you're going through the PowerPoint slides and the files, be sure to review those. And that is all.